Welcome to Trader Years, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Why that weird look on your face, Bobby?
I was just looking at the tweet that went out, and somebody wrote how elections, wars, and oil shock. Oh, okay. Rewire risks.
Okay.
Rewire is a very hard word.
Yeah. Okay. It can be a hard word, particularly for you, but we're going to, because I like the concept that the guy's saying, because I have some thoughts on that, as you could imagine. But anyway, did I give us intro? Welcome to the Trader's Edge, yada, yada. I'm Jim. That's Bob. Thank you for joining us. This is the show, one of my favorite shows, because it's live. We love the questions. We love the comments. You guys are the best. Please also join us at the Unfiltered Investor, where we take some of the topics we talk about on Trader Year's platform and dig down even deeper still. Thank you. So, Bobby, we had a war, and then we had peace. And we had, my head actually honestly spins this shit. Now we're a percent away from all-time highs. NASDAQ are at all-time highs. What makes sense of it all for me?
Well, the NASDAQ futures today on the highs were 1.44% away from the all-time highs if you're using the continuous contract.
Okay.
Which is what I use for, for planning trades.
And that's more fair. Some who were saying that it was all-time highs. You got to use it.
I think so. The thing about it to me is the volume was so light today. I mean, it was so light. When you look at a chart, for example, on Trader or somewhere else, and they show volume, that's not official volume. That's what's the word I'm looking for, Jimmy?
It's an estimate.
Yeah, it's estimated. Let's call it estimated volume. It's tentative volume. It's spurious volume. We'll get the official volume tomorrow. But if the volume sits where it sits right now, as I'm speaking to you guys, that is the lowest volume session since January 9th. Okay, right now the tentative volume has passed June 9th of this year. So it becomes the second lowest volume day since January 9th. That's not convincing as we go up toward those highs and we approach the new all-time highs. I don't use volume for trade triggers at all, but I do use it as a confirming factor at a point like this. Something Mike Arnold has always said over the years. What happens matters, but what happens where on the chart or when in the price action matters more than just what is happening. So getting close to those highs to me doesn't matter as much. And it just shows you that a lot of the things that we're rallying on seem uncertain to most market participants because they're not putting on big bets.
Right. And I did. Do you think it's silly because we're still kind of stuck just a little bit under those old highs? I tightened up my hedges again today.
No, I don't think it's silly at all.
That's how I sleep at night. I've probably spent, quarter freaking
I covered a lot of
5 years.
I covered a lot of the trades that we put on in the Unfiltered Investor, which is at unfilteredinvestor.com. I covered all three yesterday, and then I opened a new one at the close, and it's the only thing I have on right now.
You guys make sure you go and check those out. One thing I always say, and I'll say it one more time in tedium, is that you can think Bobby and I are full of shit, but one thing you cannot deny is we get great guests. This is one of our favorite guests because when we started talking to him a couple of years ago, he was such a young kid. And, Bobby and I initially will think to ourselves, what could this kid possibly know? And then he talks and it's like, oh shit, this kid knows a lot. This kid, I'll listen to him any day. If you guys don't get the Invictus macro research that he puts out, it is top line. It is fantastic. Let's bring in our friend, Mike Singleton of Invictus Research. By the way, Michael, I'm making fun of us for being crabby old men and thinking that young kids can't contribute. Not you. You've always been straight ahead on this whole thing. How are you, my friend?
I'm doing well. Thanks for having me.
Mike Singleton is not like most people his age, I know. We don't know him on a personal level, but we talk about the work he does. He knows more words than most people his age.
Yes, and he knows how to use them better. He's what I wished I was when I was that age or at this age. Where are you again? Where are you located?
Boston.
Boston. I love Boston. My daughter lives in Boston. Yeah.
It's a nice area. We're on the South Shore. So we're about 45 minutes south of Boston. But
okay, so she's in Somerville by the colleges. Where's that from you?
Where did you say she was?
She's by the colleges in Somerville, Cambridge area.
So I think that's a little north of the downtown. We're about 45 minutes south of the downtown.
Oh, okay. Yeah. Because I love going out there where, it's Harvard, MIT, and Tufts. And it really feels cool, like a college area. I love it. It's really, really neat. I think Boston's an awesome town. Is that where you're from?
No, originally I'm from Maryland, but my wife's family is from the Boston area, and it is a really nice town. I'm a Baltimore guy, and going to Boston, you're like, wow, this is a really nice city.
Yeah, it
It
is
is a
cool.
little different.
Yeah.
That's
Okay,
hilarious to me.
Bobby, you go. Yeah.
No, that's just hilarious to me. We got a comment from Steve the technician. I don't want to insult anybody from Boston, but Steve the technician says, love it here too. So if you bump into somebody on the street that looks like that, Singleton, and he comes up and he goes, I'm Steve the market technician, you know exactly what this is.
I'll remember that.
Yeah. So it seemed to me, and you tell me, I don't want to put words in your mouth, but for a couple of years, I was kind of a recessionista, and I'd read your stuff, and it was always like, pipe down, cool your jets. The numbers seem fine. And you were right. You've been right the whole time. It seems like there's been a bit of a flip, and you have grown concerned about some of the figures. Can you go into that?
Sure. So right now, I would say that our outlook, the house outlook, if you will, is for a non-recessionary growth slowdown at Invictus that's driven primarily by reduced business investment, while the labor market remains reasonably strong. And so far, the data has supported that. Broad measures of real economic growth have declined. One of our favorites is the Weekly Economic Index, which is kind of a weekly proxy for real GDP or real final sales to private domestic purchasers. And through April, or maybe March, it was running at about 2.5%, and it was accelerating. Since April, which is more or less when we pivoted from reflation to deflation, it's declined to about 2%. We think it could head as low as maybe 1.25% over the next 12 months or so. And historically, deflations, which we at Invictus, that's our parlance for slower real growth and slower inflation at the same time, it tends to be one of the worst market regimes for stocks. Doesn't necessarily mean stocks perform poorly. Our view is that this is non-recessionary, so it's kind of a mild slowdown. So in terms of framing our outlook, for us, that means we expect kind of low single-digit annualized returns for stocks as long as this persists. Another way of saying that is choppy and a little bit more volatility. So that's what we think is happening right now.
So the Fed had their meeting last week. I think it was last week. But anyway, they raised their estimates for inflation to 3%, and they lowered their estimates for growth to 1.4%. That smacks of stagflation, and another situation where the stocks don't really love stagflation. I want to concentrate more on the inflationary part of it. Do you see any signs like because he's saying, well, tariffs might be inflationary, so we're raising whatever. Do you agree with him?
No. I think it's ironic that the FOMC and Chair Powell are so concerned about stagflation, and probably more importantly, that they're actually making monetary policy decisions based on expectations regarding stagflation, because this is by definition forecast dependence and not data dependence. And in my mind, when you talk about good investing, you have to know when your thesis is wrong, and then you sell out, right? You manage risk. And policy is much the same way. When you have a thesis and it's proven wrong by the data, you have to, adjust your stance of policy. And in our view, the Fed stance of policy right now just is, the opposite of what we're seeing in the data. We're pretty clearly seeing slower real growth, weakening labor market conditions, and slower inflation at the same time, while the effective Fed funds rate is 4.25%. We might say that's, regardless of how you cut the nominal growth rate, it's probably higher than spot nominal growth for the U.S. economy right now, which means monetary conditions are very tight relative to economic conditions. So, it increases the risk of a recession or a policy error. It increases the risk of our non-recessionary growth slowdown thesis becoming a recessionary one.
All right, so I've got a two-part question, Jimmy, if you'll allow me to do it.
Sure.
The first
what
one
if I said no? I can't say no. It's you're the producer.
I can do it anyway. My first question comes with these weekly economic indicators. What's the source of those? Is this the Federal Reserve Bank of Dallas, or is it the Department of Labor? Which ones do you use? And are they an input for the leading economic indicators, which come out monthly, and they're usually almost 2 months old when they come out?
So the Weekly Economic Index is organized by the Federal Reserve Bank of Dallas. It was previously organized by the Federal Reserve Bank of New York, but they take data from a variety of public and private sources, some of which is government, right? It takes the initial claims data and the continuing claims data. It takes the Redbook retail sales data, which is Johnson Redbook, which is a private data provider. They take rail car traffic, which is done by an industry group, probably out of DC, I think. And generally, we spend most of our time looking at that headline figure. In terms of how it compares to the leading data, I would consider coincident data. It's not leading data. It tends to correlate very, very closely with real GDP and real final sales to private domestic purchasers. And leading data tends to be related to interest rates, housing, manufacturing. And so you could call that coincident data. It's coincident with the manufacturing cycle, usually, or housing, but it tends to lead broader measures of economic activity.
Okay, so part two of the question is, this morning and lately, when I was watching the Daily Edge, which, by the way, Daily Edge is every single morning, and it's just, I love Mike's format of it, 3 things that matter and then 3 things that do not matter. And sometimes I get more value out of the things that do not matter, to be honest, than the things that do. So one of the things you've been talking about quite a bit, almost like every 3rd or 4th episode, has been housing and how it's starting to weaken. My question is this. One of the frustrating things about your research for me is because my average hold time is 26 days. And this morning we had new home sales down 13.7%. That was the worst, I think, since October of 2024. And if it had been a little bit worse than that, it would have been the worst one in like 20 years in terms of change on the month. That obviously seemed predictive because I watched the Daily Edge where you talked about a housing softening and layoffs in the new housing sector starting to build and all this. And then we get the housing, new home sales down 13.7%. Does that affect what your thesis is about housing going forward? And then if I could add to that, because Tim just popped a question in the comments that's sort of relevant to what I was asking. Tim McLean, who's down here in Florida, is a friend of mine, said, does Mike think the softness in housing and commercial real estate markets start flowing through the inflation numbers in 3rd quarter 2025?
Great question.
So maybe
Long questions.
I'd first start with what's happening in housing. So what are the important things happening in housing right now? First, interest rates remain really high. The average 30-year fixed mortgage rate is about 7% in the US. That's been constant really since kind of mid-2022 at this point. So that's not new, but it's really important to keep in the back of your mind. Now, what's new is that people who own homes are now putting them on the market. And the reason that matters is now home builders have more competition, right? There's more inventory coming online. I think that the status quo for the last couple of years has been, well, I have a home with a 3% mortgage. I'm never going to sell it. And that was true for a while. But now we're seeing, for whatever reason, people who do own homes are willing to put them online. Maybe they have to move. Maybe something else is going on in their life. We're just seeing the mix of inventory move toward existing home sales. And that means competition for home builders. As a consequence, you're seeing new home sales decline, right? The market's not growing quickly because mortgage rates are constraining growth. So basically, people are just buying more existing homes and fewer new homes. As a consequence, builders are saying we're not going to do as many new starts because demand isn't there. And actually, home prices are declining as a result of that. We've gotten 2 consecutive months now of declining month-over-month national home price data from Case-Shiller.
Right.
So, what you're seeing in housing is you're seeing rising inventory levels. You're seeing reduced home starts. And historically, when that happens, when that spread between new starts and inventory, widens enough, you get layoffs, right? Because your demand relative to demand, and you have to start, cutting heads basically. Now, we're not at a point right now that spread is screaming recession, but we're seeing nascent weakness. That's what we're calling it, is nascent weakness in the housing market.
So
to get to Tim's,
oh, sorry, you go. I thought you were done. Yeah.
To get to Tim's question, when does this start bleeding into the inflation data? Well, you'd see it through the transmission mechanism of the labor market. So right now, despite everything I'm saying, home builders are still adding new jobs every month at roughly a 2% annual pace, which I think is a little bit surprising. It's surprising for me, but it doesn't matter whether it's surprising. The fact is they're just not laying anyone off yet. In order to see this weakness in the housing market transmit into the inflation data or even into broader economic weakness, you need to see home builder layoffs. And so that's a time series that we're watching really closely. We get it every month from the BLS. So could it happen by, I think Tim asked, maybe Q3 of 2025? Maybe, but we're not seeing compelling evidence of it yet.
So 2 things. First of all, thank you to Money Over Mind, who just retweeted us. You guys are the best. That earns you a follow. I'll follow you back. We've been talking on Twitter for a long time. You're an excellent guy. Thank you for that. Michael, we had Melody Wright on last week, and I wrote a thing about it on our letter. the unfiltered investor, because she scared the shit out of me regarding real estate. She contends that it is the coming plunge is going to be worse than the Great Recession. Now, here's my problem with that, is that we've been talking about somewhat of the lack of supply of homes. We've been back then, it was all leverage isn't created equal. BlackRock having leveraged out to buy a crap ton of homes is different than the stripper from The Big Short leveraging up to buy 5 or 6 homes, which really was the case back then. Do you anticipate, and I know you're more about seeing data and changing your minds in real time than about predicting what could happen in 6 months, but if you'll maybe take a crack at it anyway, do you see something fundamental that could have us have a 40% housing price slide like she's predicting?
I think that's virtually impossible. Total active listings today are something like 70% below where they were in 2006. And that's despite a population, the number of people seeking shelter that's 15 or 20% higher. So I don't think that home prices have much further to fall. I think if we have a recessionary scenario, maybe home prices decline 5% total. But the reality is we have a long-term shortage in housing, particularly in popular metropolitan areas like DC, Boston, New York, Chicago. The truth is there's just not enough housing long term, especially if the US population continues to grow at 1 or 2% a year, especially if we continue to see urbanization. I just have a hard time imagining that real estate can contract more than 1% or 2%, or draw down from peak more than 1% or 2% before eventually demand finds itself again and housing prices are at new all-time highs.
So it's interesting, Jim and Mike. Tim and I, who asked that question, went for lunch day after that Melody Wright show. And he said almost the exact same thing, word for word, in terms of levels of housing and the shortage and all that. So I expect quite a few more questions from Tim in this particular episode if he's still watching. So let's talk about stocks today. I know you don't necessarily make predictions day to day, but was there anything about today's price action that made you think that some of the uncertainty that's built into the market? Jim and I were talking earlier that NASDAQ futures, it's only 1.4% from its all-time high, up 34.5% since the April lows. Do you think this is overdone by sort of the shortest your mind can wrap that you can wrap your mind around it in terms of the short term on this? Do you think it's overdone at all? Or do you think it's doing pretty much what it should do?
So I would say that I probably wouldn't be chasing aggressively right here. Big picture, our macro view is for a non-recessionary growth slowdown where real growth goes from something like 2.5% to something like 1.25%. So historically, what does the stock market do? It's choppy, range bound, but with an upward drift, right? So for us, our framework going into a market like that is when you get to the high end of a range, you want to be reducing that. When you get to the low end of the range, you want to be adding that. And so, right now I'd say we're at the high end of the range, wouldn't be chasing. But I think that if where's the market 6 or 9 months from now? Probably a little bit higher. I don't think we're going to see banner years. I don't think we're going to see 20% returns like 2023 or 2024 unless something dramatically changes in terms of policy. But I think the market could still be up.
Bobby, what do you think about that? Because you do a little more further out prognosticating. To me, you mentioned the low volume today. We are coming up on those highs. We have Donald Trump as president, and there's either things that he does that creates volatility or things that the media emphasizes that he does that may cause volatility. Do you think we take out these highs on this run?
I guess it depends on what you mean by this run. My answer is yes. I do think we take out the highs, and there's a couple of reasons. I think that the big, beautiful bill, which now Trump is refocused on, right? It's one of the first things he tweeted about this morning after he said, the war's over. I ended the war. It's over now.
He's been working on this, Mike. What do you think?
That's pretty good.
Nobody ever
not
saw
bad,
a
right?
war end faster than this or better. Nobody ever saw it before.
People are saying, yeah.
People are saying, I don't know why they're saying it. Maybe they like saying it. I just love doing that. I think he's focused back on the bill, and that bill to me is stimulative, okay, in the short term. So, and I think it's stimulative enough based on the spending, which none of us like the spending as a core thing, like as our core beliefs. We think the government has to get more fiscally responsible. I know Jim and I think that. Mike, I think you do as well, medium to long term. But in the short term, I think it's stimulative. And in the medium term, I don't think the Fed does shit except cut. I really don't. I think they want to cut. I think they're going to cut. The odds of the September cut have actually been ramping up, not dropping off.
Right, I saw that.
You saw that, right? And then we're back to 5 cuts being priced in, according to the CME Fed Watch tool, through 2026. I don't think we'll get 5.
Have you read Bianco's research on that too? Because his contention
I have not yet.
His contention is that there's mutiny at the Fed, and there's historical precedent for this when several Fed members kind of are more aligned with the president pressuring to lower rates. And I think it's Bowman and Waller, but don't quote me on that part. Jim Bianco thinks there's a bit of a mutiny going on. Well, let's say, Mike, that the Fed does cut twice this year, twice more Q1 next year. Will that give a kick start to risk assets?
It's hard to say. I think that there's 2 elements to Fed policy and how they impact stocks. I think the first is just through interest rates, right? And the relationship between interest rates and valuations. And on that level, I don't know that the Fed cutting is going to have a substantial impact, because I don't know that the 10-year will decline in the instance that the Fed cuts once or twice.
Probably won't. It didn't last time. Yeah. Right.
Right. I think you need to see balance sheet policy change to see the 10-year decline dramatically. And I don't think that there's any line of sight.
You mean you need to see the Fed buying 10 years again, right?
Right. Otherwise, I think lower rates probably means a higher 10-year, or, a range bound 10-year, right? You're still running, likely to run a 6.5% budget deficit this year, 7% the subsequent year if the big beautiful bill passes. You're still running QT. I don't know why the 10-year would decline dramatically on a 25 basis point cut or even a 50 basis point cut.
Right.
So
why do we have to call it the big beautiful bill? It's such an asinine name, and I do the same thing. Don't get me wrong, but
I don't know. Is there an official name? I mean, again, we should ask Mike this question. We've asked a couple of guests if you're a dictator for life. I'm sorry, dictator for a day. I'd like to be a dictator for life.
So
I don't want to be
everybody.
Dictator. I'm tired of this job already. If I were dictator for a day, I would ban naming bills. Bills would just have numbers. It'd be like C3-1820. That would be it.
Yeah.
Right. Because
like the right to work bill or the
Inflation Reduction Act, which was an inflation juicing act, if anything. Right.
Yeah.
But I don't know. Does this bill actually have a name?
The House spending bill was called the Big Beautiful Bill.
Awesome. That's so stupid.
We live in a wonderful world. By the way,
we live in a world where I've already gotten a couple of emails with headlines saying, why did the NATO Secretary General call Trump daddy? He did.
Did he really?
Well, he didn't call him daddy. Trump was like, they're like 2 kids fighting in a schoolyard. They've been fighting for so long. You let them fight for a couple of minutes, then you make peace and you tell them stop fighting. And the guy goes, yeah. And then sometimes, daddy has to get involved and you're daddy.
No doubt about it. I want to bring up one thing. Do you remember back in Trump's first term, where like the media and all the left people on the left were like, well, he wants to be a dictator. I mean, I remember talking to this one guy who worked for me who was a huge leftist. And I'm like, do you know who else wants to be a dictator? Everybody. I want to be a dictator. You know what I mean? Being a dictator seems really fun. Okay. I'm not. And we have checks and balances within the system. Anyway, I digress. Bobby, your question.
Yeah. So if you're talking about the 10 years, so what does Trump, and we haven't heard much out of Besson lately. And I think that's probably because military geopolitics is sort of taking center stage. But do you think there's any sort of trick that they could have up their sleeve that only smart guys who went to Notre Dame would be able to see to lower the 10-year? Because we know that that's what they want. I'm talking about other than more QE.
Like SLR reform or creating demand through stable coins or
go.
It's a good question. I actually don't have a good answer to it.
Well, they could raise rates to 6% on the short end. You know what I mean? If the market thinks that there's going to be deflation, I don't know. Yeah. Whatever. Yeah. And no room for growth. But anyway, you go. Sorry.
Right. So I essentially my view right now is that the 10-year is basically range bound, maybe with a slight downward bias, because historically, regardless of what's going on with the deficit or issuance, term premium tended to contract when economic growth slows, just like all risk premium contract. And so if growth is really going to go from 2.5 to 1.5 or whatever, it's really hard to have an outright negative view on treasuries. Definitely not our favorite asset. We're not necessarily overweight treasuries, but we've been bearish treasuries since like 2022, and we're no longer bearish treasuries.
That makes sense. That makes a lot of sense. So when you look at the 1%, you're saying like stock markets below average returns, which I actually kind of agree with you. I've said that from the beginning of 2025. I will change my tune in 2026. I believe if we're done with the bill, if we just have some what I consider pro-growth policies. But anyway, are there some sectors that you think will do better? And I want you to particularly look at commodities, tech, defensives. What do you think?
So I think it's a good question. I mean, historically, what's performed well through deflations? It's generally defensives, right? It's generally staples, utilities, healthcare, real estate. Now, through this deflation, we're actually not overweight those sectors, but mostly as a result of the market signal, so to speak. Generally, when we have a fundamental view at Invictus, we want the market to be confirming it, and we use some different measures to evaluate that before we invest. And right now, when you look at the trend data, the relative performance data, the momentum data in those defensive sectors, they just don't look good. They don't look good on their own, and they don't even look good relative to the broader market. So it's really hard for us to be overweight them. So we're actually, long financials, technology, some more cyclical sectors. We like banks, believe it or not. I think as the yield curve steepens, that will be a tailwind for banks. And we're short home builders, biotech. I think the fundamental case for home builders over the short term is still pretty bearish. Note that the relative performance is really, really poor. They're making new 52-week relative lows. Generally, we find that's a better place to look for selling or shorting opportunities and buying opportunities. So that's more or less how we're viewing things right now. We still like Bitcoin. We like commodities that are not related to the energy complex as much. We like a healthy amount of cash. You're still getting, 4.5% on cash. But financial assets just aren't totally attractive to us. It's not all in. This isn't a robust bull market. We're not seeing the beginning of a new economic recovery because we didn't have a recession.
Right. This will seem like an odd question to you, Bobby, but that company I shorted last week in anticipation of problems in the housing market, because again, I'm mostly a technical trader, so it's not that unusual that I forget what the company does. But they were a lender of sorts, weren't they?
Yeah, they're a non-bank lender.
A non-bank lender. Okay, right. Okay, that's who I shorted. I shorted mostly because of the technicals, and mostly because I think housing is going to have a tough time. Which is funny because I'm also long banks, and I believe in that. So in tech too, because the tech charts still look pretty good to me, Bobby.
Yeah.
First of all, good afternoon, Remo, and then Luis. I just put up. I just shared my screen. If you could put that up, Jimmy, Mike. This is from Widge, who's not in the comments right now, but I saw that he posted this on Twitter. So Widge, or you guys, does this mean the bill is named HR1? I mean, this is Congress.gov. One Big Beautiful Bill Act is the name. But can we just call it HR1?
Or OBA? No, HR1's better.
No, HR1. What I don't know is maybe HR1 is a designation of where it is in the
I don't know.
I don't know what that means.
But it is called One Big Beautiful Bill Act.
Yeah, Widge would know because he's smarter than all of us. So that's all. That's all I wanted to do.
Take a quick time out. Luis, can you post the banner? This is the part of the show where I ask a favor from you guys. If you like the show, if you like what we do, please try for 3 months for free. Tradier's what's it called again, Bobby? Tradier Pro options platform. Okay, I'm not a journalist. I'm a trader. You guys just shut up. Right? But here we go. So try it for 3 months free. There is no obligation. We've talked to high-end options traders who use it and love it, novices who use it and love it, and everywhere in between. So just please scan the QR code and give it a go. There's no obligation. 3 months free. Thank you guys for supporting us, Bobby.
Remo just put an article. It's stock charts for those of you that don't follow Remo. An article that says most metros require more than 30% of income for housing. Most metros require more than 30% of income for housing. It's from the St. Paul Business Journal.
So he's saying it's expensive as hell, right?
Yeah, he's saying it's just still pretty expensive, which is weird because I live in Southwest Florida and prices are coming down. I wouldn't say they're collapsing.
But inventory increased first considerably, correct?
Yeah, inventory increased first.
Yeah. Okay.
So, Mike, kind of changing subjects here a little bit in terms of the equities as sort of a monolith. Okay. Your time horizon is approximately what? Because that'll lead to the second part of my question. When you're talking Invictus research, you don't, or do you not look at it that way?
I have a mentor who used the line, I'm a long-term investor as long as the market lets me be. Which
so
I
you
thought
don't
was
look
pretty.
at it that way.
I would say generally we're trying to underwrite for a year, maybe a year to 18 months.
Okay. So based on that, you do a lot of, one of the things I like is about your research is you'll throw in every now and then, if you use the 200-day moving average and momentum when it's beating, consumer cyclicals by this much or blah, blah, blah. You've done a lot of those lately, and I really like those. I don't necessarily use them. I just like knowing about them. Which is your favorite right now? Those sort of like combined metrics where you outperform, have a good Sharpe ratio. I don't even remember it all. I'm just gonna let you talk about it. Which one's your favorite one of all those you do?
There's a couple, I would say. So there's a couple that come to mind quickly. So the first one I would note is that when you see the S&P 500 go up, I'm going to mess it up now, of course. There are a lot of folks who are worried that we're going to like retest the bottom. I think probably fewer people are worried about it now than there were a month ago. But essentially, we've seen an enormous momentum thrust off the bottom. When you see the S&P 500 go up, I think the number is 10% in 20 days. Historically, that's a very reliable bottoming signal. And the market is up, it's like 70% 3 months later, 6 months later, 12 months later.
70% of the time.
After you've seen that figure trigger, so going back to 1960. And so, that momentum thrust is one of the variables informing our view that, we're not going to retest the bottom. We're up off the lows. We're more likely to see a range-bound market than a prolonged bear market, although, of course, that could change. And the reason that I like that signal is partly because you don't see momentum thrust like that very often. And so when you do see it, it sort of sticks to your ribs a little bit, right? You have to acknowledge that even though the market is up a lot and it's up fast, it doesn't mean that there has to be some sort of mean reversion or that you have to retest the lows. It actually signifies the opposite, that you probably should re-risk. The way that I think about it is when all of the smart money is re-risking at the same time, that's usually because there is an important, there's an important fundamental development that you have to reconsider. It's not that I can see Tim said it was the Zweig momentum thrust.
I call it the Singleton momentum thrust. Why can't we just name things what we want? Okay,
yeah.
Come on. Yeah.
There have been a bunch of thrusts. I'm just using a very simple one because it's easy to remember. Up 10% in 3 weeks. It's easier to remember than whatever this. I can't remember the specifics of the Zweig one, but it's much more complicated. And it works equally well. The second thing that I remember and I think is really important is it's easy to get really carried away with great stock picks and everything, but actually a portfolio of 1/3 stocks, 1/3 gold, and 1/3 REITs, which no one talks about, actually outperforms a buy and hold S&P 500 portfolio by 100 basis points a year, going back to 1972, with a Sharpe ratio of 0.9 and a max drawdown of 38% versus 52%. So for me, what that indicates is the value of having a strategic asset allocation, a balanced portfolio. And then from there, you can overweight or underweight. Right now, we're underweight real estate, but having that framework and in the back of your mind where you're getting the benefits of diversification and actually can recreate stock-like returns with lower risk, it's really, really powerful because I think I'm inclined to, and a lot of people are inclined to be stock jockeys. And not that there's anything wrong with that if you have considerable edge, but if you don't, a balanced portfolio is an incredible thing.
Can I ask a quick question about the REITs? What are your favorite REITs? Like if I'm looking, because I'm looking maybe to lighten up on real estate, and I have a lot of physical real estate, but so I might be shorting some in there. What are the REITs you look at?
Real quick, Jimmy, before you answer, I just want to say the Zweig thing is a 10-day moving average that examines the ratio between advancers and decliners on an exchange.
Got it.
So that's what the Zweig momentum thrust is.
Yeah. Back to REITs.
All right, REITs.
So right now, I think REITs are probably an underweight. Just for me, on a technical basis, I think that when I look at a chart of RSPR, which is the equal weight real estate ETF, and I think if you looked at IYR or XLRE, they look pretty similar. To me, they look like they're at the top end of a range. They're demonstrating weak cross-sectional momentum relative to the broader market, and overbought with weak momentum. That looks like a sell to me. That said, I like the tower REITs longer term, right? I like American Tower, Crown Castle. I think that the story there extends beyond real estate. And
can you tell me what that story is? I'm caught off guard on that one. I don't know what you're talking about.
The tower REITs they own the land underneath cell towers, and they lease the towers to not Sprint anymore, Verizon, AT&T, the big cell carriers. And so they have these really reliable tenants. They have, really aggressive escalators in their contracts. There's very low credit risk. And these stocks have outperformed. They've just trounced the market for, forever, basically, since maybe about 2000. Wow. When you really started to see the boom in, telecom and particularly mobile. And, I don't think that trend is going to slow down anytime soon. So I think that and they have these international portfolios that are growing really quickly now. And so my expectation is those continue to be outperformers even within the REIT space.
So I want to ask you about another one of these things that you mentioned, the Daily Edge, a couple of weeks ago. And I should probably give you a heads up for these so that I could either pull them up on the screen or you could. But you talked about a study you did about momentum and how momentum doesn't necessarily matter. Let me rephrase that. EPS and things being too expensive based on revenue or earnings per share estimates doesn't matter as much as it did maybe 30 years ago. Do you remember that one?
No, I don't remember that one.
Never mind that.
It's funny.
Yeah, moving right along. Right?
Yeah, no, it was something you did a few weeks ago that basically said that momentum matters much more than whether a stock is relatively expensive or relatively cheap in terms of where it's going over the next 12, 16 months.
Oh, that's framed that way. I don't remember a specific study, but it's true that there are not very many stocks where you can find a reasonable correlation between price to earnings today and any measure of forward performance. And price momentum is generally a better predictor of forward performance, whether you're talking absolute price momentum or cross-sectional price momentum. So momentum relative to the broader market.
Yeah, and there's a real live reason for this too over the last 30 years, and that's because of an activist Fed injecting liquidity into the market and just money being thrown at the problem, creating correlations, right?
That very well may be so. Actually, I think it's funny if you look at the valuation of the S&P 500 today and 1 year forward returns, there's actually a positive correlation. It's very small. It's not meaningful. I just think that's funny because every value investor looks at the valuation of the market, makes these determinations based on whether they think it's expensive or not expensive. And of course, they're probably creating a slight drag on their performance by doing it that way.
Right.
I want to answer Brad Freeman's question. He's at Stock Market Nerd. I don't follow him and he doesn't follow me, but he just said, how do I short a city? Now, obviously that has to do with New York, right? And how New York just, I don't think Andrew Cuomo was a good choice either, but New York just basically nominated for the Democratic Party's candidate for mayor, a socialist. Yeah. I don't care about the Muslim thing. Doesn't bother me at all. But he's now a candidate for mayor running against a Republican, and the Republicans never win. So he's essentially the mayor. So is there any reasonable way to short New York City?
Buy land in Florida.
Yeah, no, that's not a bad idea. Yeah. Or
our
Nashville.
friend Tony Nash put up on Twitter today, stop telling him to move to Texas, send him to Florida.
It's like, no. Maybe Nashville. Nashville is a good idea.
This is what I said. Scott Shelley and RFD TV today asked me what he thought the name of the block should be that we were talking about the mayor of New York. I said it should just be Congratulations Nashville. So that's what I thought would be it. But that is interesting, Bobby. You can't think of anything unless sell the debt, right? But that doesn't even work because
it doesn't even work. I mean, you can't sell New York. Maybe there's a New York REIT. Maybe there's like a New York real estate REIT you can short. Yeah. But even then, shorting it's probably difficult.
Yeah, and also the federal government bails everybody out now. No city like New York is going to be allowed to fail. None of us are standing in New York. All of us will be bailing them out if the policies are as bad as I think they are. So it doesn't always work. Like people still lend Illinois money because they know that there's an implicit backing for the federal government. Get the hell out of these states. Let them compete against each other like the God and the Constitution intended. You mentioned gold a second ago, which is, again, has been one of Bobby and I's favorite assets for the last couple of years. Bitcoin, I didn't intend it to be my favorite asset, but it's turning into one of my bigger positions just based on the price. And I think both of those are like a vote of mistrust for stewardship of our currency, not just our currency, I guess, but global currencies. Is that the thesis that you're putting forward as well, or is there something more?
Yeah, I think it's that. And then also just on a technical basis, they both look really good. They're both demonstrating really strong momentum, great trend by our work. And those are assets that we want to be involved with, particularly when our outlook on stocks is not as good. Flagstar Bank, that's true. That was formerly New York Community Bank, so probably has a lot of exposure to New York. But, you also have to think like, all right, let's imagine we do have a choppy range-bound market and stocks occasionally sell off 5% or so. What are the beneficiaries of sell-offs like that? I think it's probably gold, probably treasuries to some extent, and maybe even Bitcoin. Bitcoin demonstrated really remarkable relative performance through this most recent sell-off in April. And I think that that's probably a decent harbinger of relative performance going forward. It's hard to imagine almost an economic outcome where Bitcoin doesn't perform reasonably well. And so, given I just said that, it'll probably drop 10%, but
which is nothing for Bitcoin, by the way.
Right. Yeah. But that's basically the way that we're thinking about it right now. Also, gold miners. I should have mentioned that as something that I liked in the when you're asking me about stock and sector exposures. Gold miners continue to look really good
because they've underperformed and because there's somewhat of a leverage play on gold. Correct.
Right. Right.
Okay.
Yeah.
By the way,
I think that's
I got the chart up of Flagstar, got hammered today, but it did recover most of its losses. It traded from about yesterday at about 11.5 was its high, down to 10.5. If I have the right chart up, FLG.
You do. It was down 6.65% on the lows. It's closing the day down about 3.87%. Huge gap lower. Ugly freaking chart.
Yeah, I think the move isn't pronounced enough. It just, how do you turn a city into a hellhole? You try to control all the prices and just discourage any sort of market competition. And that's exactly what he intends to do.
Jimmy, I'm about to bid $200 on a house in Bloomingdale, Illinois. That's for sale. 4-bedroom, 2-bath, 2,500 square feet. It's auction tomorrow.
You got to knock it down, obviously, right?
I'm bidding $200. I don't have to do anything with it.
Well, no, because all of a sudden you're going to start getting fined for different code violations, and it's going to cost you 20 grand to knock it down.
I don't get fined for codes in Illinois.
Okay, all right. Come and get me.
We got a comment by Widge up here that I want to put up if we could. On the 2025 versus 2006 housing comparison, might we be speaking past each other because multifamily speculation seems to have replaced the single family speculation of 20 years ago? I'd be shocked if Tim doesn't put a comment on this as well. Mike, what do you think?
That's possible. So I think he's right that the statistic I was referring to does refer to single family and multifamily. I'd have to look at the single family data. That said, I think single family is widely considered more desirable than multifamily. So I have a hard time imagining an outcome where single family really takes it on the chin. I guess it's possible that multifamily dwellings see more dramatic price declines. I guess
I think is what he's saying, by the way, right?
Yeah. That could be on the table. I'd have to do a little more work on that, but that's possible.
That is interesting.
So, Mike, what is your thesis right now? In other words, like your overall thesis. I think I've heard you say that you're more in the stagflation camp, but I don't think you mean like recession plus inflation camp, right?
No, I would say that the outlook right now is deflation, which means slower inflation. And we're qualifying that call by saying it's a non-recessionary deflation. So in other words, more volatility, more range-bound trading for risk assets, but with a slight upward drift. Because if you do a back test and you say, how do different assets perform deflations, it looks really, really bad because all recessions are deflationary, but not all deflations are recessionary. So we're making the distinction that it's a non-recessionary deflation.
Tim's point is
so it is stagflation then. Go ahead, Jimmy.
Tim's point is excellent. When I was in Austin speaking at a Bitcoin conference last summer, in the 4 or 5 square block area I was, there was 4 high rises under construction. Now I'm not talking small ones. It must have been bigger than a 4 or 5 block area, but it wasn't a big area. And they were like 30, 40 story condo buildings being built. So, I mean, it did not take any sort of genius to realize that there were some overbuilt, animal spirits that had taken the pendulum a little bit too far, I would say, right? Yeah. Either of you?
Yeah, I'm reading Widge's comment, Luis, if you can put that up. Widge says, to Tim's point, I think this is what Melody Wright has been pointing to for the past couple of years, is multifamily versus single. But I agree with what Mike Singleton said. It's hard for me to see, first of all, and Tim could confirm this, so because Tim is in commercial real estate, lending as well as brokering, but I don't see, I mean, down here in Florida, that stuff is still built on loans, but the people themselves are pretty capitalized. So while you might have, a project or 2 or 10 go under, it doesn't really hit the overall economy because it doesn't hit a bunch of little individuals here and there that are then unemployed and completely destroyed for years and years.
The number we had to find, Bobby, was ones that are under construction, not completed yet. You know what I mean? Those are the ones that could topple quite easily, that aren't capitalized by the salespeople. But anyway, do we know any sort of ETFs that are just multifamily or just focused on multifamily? Is that a thing that anyone's watching or no?
It's not one. There's not one that I know of.
And Widge or Tim, if you guys know that, please kick it up, because that would be valuable to me to put it on my watch list too. Yeah. So.
Real quick, Tim just said that he agrees with what I said. And again, I'm talking about, an area like Florida. I don't know enough about multifamily real estate to say anything toward that. But I do want to go away from markets real quick. Luis, I posted something that I found really, really interesting this week. And Jimmy tweeted about it here. So let's talk. Anyone else find it extremely fortuitous for the WNBA that they were having problems with bullying of Caitlin Clark, and all of a sudden a 6'3" blonde who looks like a supermodel magically appears as a new enforcer in this saga? This is your most accurate tweet ever. Ever.
Is it bad that I look at everything so cynically?
No.
Mike, what's your take on this?
Mike started laughing, so he knows what we're talking about.
Right.
No, I've actually seen this. I'm on Twitter enough that I know exactly what he's talking about. Yeah. And it's a little funny. It's looks like WWE, right? Like all of these characters. All of these characters.
A guy who came at me was like, "Fuck you, dude. She's been in the league. She's a good player." I'm not saying any of that. I'm just saying. Right? Yeah. It couldn't work out any better. Yeah.
It's very similar to how Dennis Rodman ended up in the second three-peat of the Bulls. Like,
but
that was
wasn't totally hot. Yeah.
No, but he's a guy, so you wouldn't be looking
for
care
if he's totally
for someone that was completely crazy to take the pressure off of Mike in his second trip around. And not that Mike ever felt pressure. I mean, I don't think the guy ever felt pressure.
Yeah.
But by the way, this LeBron versus Michael stuff, everybody just stop.
If you ever watch Michael Jordan play, you would know the answer. You watch him play one game, and you would have known the answer. It was.
I had a guy say to me, "Well, I believe LeBron is the best from the eye test." Like,
you're doing the wrong eye
How many
test.
fingers am I holding up? I mean, you're an idiot.
Right. Yeah, it was amazing. Michael, what is Notre Dame starting out the season as in football? And then I'm going to bring this conversation back to the 12th ranked Illini as soon as you answer, because I don't care about Notre Dame. But go on.
I don't start to do my research on the Notre Dame football season until 2 days before the opening kickoff. So I'm not up to speed on anything right now.
But your guess is they're probably in the top 15, you'd say, right? They were in the championship last year.
Oh, right? Yeah, we're going to win the championship this year for sure.
Of course you are. Now, back to what I was really just opening the door to. The Fighting Illini are ranked number 12, predicted to go to the playoff. What do you think the market ramifications are of that, smart boy?
Ooh, what team is this?
The Fighting Illini. Perhaps you've heard of them.
No,
Illinois.
Who is this?
He's never heard of them. All right, real quick back to markets.
Yeah. One more market question. What do we got?
Non-recessionary stagflation. I've seen your equity sector back test, but not a lot of people have. So what are the best performing sectors? Not that you're saying people should buy those sectors, but typically, what are the best performing sectors in that kind of an environment?
Well, to be clear, non-recessionary deflation, which means slower inflation. So
okay. So you're
I
not
think
calling for stagflation.
earlier what I was saying about stagflation is that the Fed, if you look at the summary of economic projections and their revisions, the Fed clearly expects stagflation. But I think that the Fed is, they're not paying attention to the current data, or they expect the current data to change really sharply in the coming months. Our view is that they are offsides and exhibiting forecast dependence as opposed to data dependence, which they claim to abide by. The best performing sectors through deflations are usually, I'll just say the best performing assets are usually gold, bonds, mild deflations. Credit generally performs pretty well. And then you go into stocks, and stocks can still earn good returns if you're not going to get a recession. But usually it's defensive leadership. I actually think the fact that we're not seeing clear defensive leadership right now is a good sign. It's a sign that, maybe this non-recessionary growth slowdown is just sort of a steady economy at 2%. Maybe growth doesn't slow as much as we expect. That would be a good thing. I don't think that I don't think it's late enough for us to say, we're not going to see a deflation. Growth is actually going to remain stable at 2%. But, the market is stronger, actually a little bit stronger than we expect given economic conditions right now.
So there's one thing. Okay. I know you don't speak as hyperbolically as I do, or even as Bobby does. You're very, very measured, young man. And this is an honest question though. When you
do that grandpa stuff, you're a very measured young man.
Well, no, you are very measured, which I love. It
comes from having daughters and son-in-laws, which I don't have any kids, so that's where it comes from. But I really do like it when you do that.
No, okay, thank you. But anyway, so do you perceive, when you look at 10 years in the future, 20 years in the future, will Mike Singleton look back at this Federal Reserve regime and say, like, what would your grade be? And the futures, the unfiltered investor will use +3 to -3. What do you think your grade will be on this Fed in 10, 20 years?
So I'll tell you a fictitious story. When I was in high school, I shot a backward shot from half court and made it. It was a swish. You think the class remembers me as a great basketball player? I actually think I like Chair Powell, and I want to believe that he's one of the greatest modern Fed chairs. I think that if you just look at the outcomes, you could make a case that he sort of threaded the needle with this soft landing, at least so far. I do think a fair amount of it was luck. I hate to say that.
But what about missing it in 2021, missing the inflation?
Yeah, I think that was a policy mistake. He's done some stuff that I think is, in retrospect, obviously not right. He waited too long to hike rates. He cut rates right before the election and hasn't cut them since, despite softer data. I don't really understand any of that. But I think the fact that he's managed to obtain the soft landing, at least so far, and he'll probably be out by the time we get a recession, just the fact that he was able to hike 450 basis points and not get a recession, I think people will probably remember him as being a good Fed chair.
That was not the question.
What do I think? I think I'm inclined to say he's been less political than past Fed chairs, certainly less political than Janet Yellen. And his economic outcomes have been okay. Most of the problems weren't his fault. I think they were fiscal policymakers' problems.
So that sounds like a +1 you're going to give him, you think?
I'm like kind of neutral on him, to be honest. I don't have a super strong view.
I got one last one for you, Luis. If you can just put this up. This to me is the funniest story of the week. Trump was nominated for a Nobel Peace Prize by somebody in the House of Representatives. So I asked ChatGPT to make a cartoon picture of Trump winning the Nobel Peace Prize. This is just hysterical to me. Absolutely hysterical to me.
I agree. I agree.
I got a comment from I'm not sure if I should even put this up, but Luis, let's put up Edward Beggs' comment, because Jimmy, you know who this is? Jim loves BlackRock. Is that you, Jimmy?
Well, no, I don't love BlackRock. I just acknowledge that BlackRock is the evil empire. There's a difference. But anyway, moving right along.
Okay, so that's sarcasm from Edward.
Yeah,
I'm guessing.
Yeah, right.
BlackRock Floating Rate Income Trust is a closed-end bond fund with the primary objective of providing a high level of current income. It also seeks preservation of capital to the extent consistent with its income goals. BGT invests in a global portfolio of floating. This sounds like we're selling this, doesn't it?
Yeah.
Edward, we're not selling BlackRock shit here. It's not doing that.
I do have a BlackRock dividend fund that I've had for years, but anyway, I'm not. Yeah. Thank you for that, Edward Banks. Let's wrap this. I got to go. Cool. Mike, tell them where they can find you.
All right. You can find me at Invictus Macro on Twitter, or you can find us at our website, which is invictus-research.com.
And you guys should. Mike's research is absolutely fantastic. And thank you so much for coming on. We really appreciate it. This has been Trader's Edge. Before we go, some housekeeping. Thank you guys very much for all you do. The DMs, all these comments you say during the show, they make it fun for us. And I hope that comes across. And I hope there's some takeaways as well. Remember Bobby and I's story. We were in legacy media for a long time. We wanted to be part of a platform where there isn't an overzealous producer or a sponsor telling you what you can and can't say. And this is one of the places we found it. Please join us at the Unfiltered Investor. Thank you guys and have a great night.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.